Okay, guys, today I have on a guest that needs very little introduction. Lyn Alden, probably one of the most thoughtful and highly regarded macro analysts, but also just somebody who has very sharp thoughts on, I think, a lot of things in our space. To that end, I am maybe perhaps not the best person to sit here and have an hour-long macro conversation with you. So we'll touch on that at the end, but I want to maybe ask you some questions that perhaps you don't normally get when you go on podcasts. So Lyn, thanks again for coming on. Let's start with the Coldcard incident. Obviously, this is top of mind. We don't have to spend too much time, but and we also no real need to rehash it apart from maybe just some basics. But does this change your mind on anything with regards to Bitcoin, self-custody, maybe some of the messaging that we have as a community put forth and are maybe rethinking now? I don't know. What are your overarching thoughts on this recent Coldcard incident?
Yeah, good question. Thanks for having me. I think there's a handful of things here. I think that the one question about does it change my view on Bitcoin custody? I mean, the answer to that one is no. I think that has to be kind of a long-term usable and at least optional thing in the Bitcoin space. I do think it changes some of the kind of practices, which I think is natural. There's been occasional ecosystem shifts throughout Bitcoin's now 17 plus year history. I think this is another one. It's one of the big large ones, I think, comparable to kind of prior shifts, even going back as far as kind of the introduction of the concept of a hardware wallet, a dedicated device for this. I think that with the rise of AI, especially now that open weight models have kind of gotten to the point where they're very good when it comes to cybersecurity exploits. I think we're in a rapid era where all existing code bases have to be checked with AI and hardened against this. I think this is going to be a process. This was a mistake that was blatant enough that it could have been exploited without AI, and it was found one way or another. I think one of the heuristics that failed here was the Lindy effect, which is that the longer something's around, generally speaking, the more kind of robust it is. That's kind of a general rule of thumb. I think the adjusted one is longevity and size. And so, I mean, products like Trezor, products like Ledger, they have a much larger track record of product shipping, more employees. There's just kind of more capital in the space interested in auditing those code bases and things like that. So I do think that there's somewhat of a heuristic shift where not just longevity, but real size matters in this context, and kind of the importance of independent third-party audits, either human or AI, or both probably going forward. I do think that self-custody probably took a step back here for at least a period of time. It's not as simple as, just write down 12 words, don't worry about the device. Now there is kind of a deeper stack of things to consider as software attacks get more and more sophisticated, thanks to AI and otherwise. So potentially the curve went up a little bit, the difficulty curve. I think the advice that still is very valid, that has been for a long time, is multi-sig. I do think that the UX is pretty good, actually, especially when you use some sort of collaborative solutions. And I think that this will probably further make that more of a reality going forward, now that there's kind of more emphasis on it. So I think this is another big kind of shift in the industry, but I don't think it radically changes the value proposition of what the asset offers. But I think it does shift how some people are going to interact with it, probably for the rightly.
Yeah, I think obviously one of the long-standing thoughts, and especially put forth by Bitcoiners, is that self-custody is not necessarily an imperative for everyone. It is a big responsibility, but the ability to self-custody is imperative, right? In the same way that the ability to spin up a node permissionlessly and verify the chain is imperative, at least at the base level. You wrote a paper with Steve Lee, our friend, and Ren a long time ago, and it was broadly about Bitcoin consensus as a whole. One of the big takeaways, and it's something that I think a lot of us intuit, but is interesting that was really broken down in the paper, is the importance of self-custody with regards to the direction of the chain, perhaps in various different threat models, right? So in this context, it's suppose we have some fork choice, and one of the value propositions of self-custody is that the faster one, the faster, but also perhaps the more Bitcoin you have, the more influential you can be on one side or another of a fork. And I think this is a very good point that like we should remind ourselves, and like collectively, a lot of people with self custody can, ensure that Bitcoin stays decentralized long run. I think one of the concerns is that if there is a decreasing number of people self-custodying, you do sort of end up with these situations where like very few people hold the vast majority of Bitcoin. And I wonder if this is, like you talked about multi-sig, like there's a lot of good solutions out there now, but I wonder if this is just another, another instance where like people are pushed to custodial solutions, and then eventually we get into these situations where like it actually is scary that IBIT or Strategy holds the vast majority of Bitcoin. I don't know if you have like thoughts on that. I wanted to also shout out your paper. Is like quite long, but I did indeed read it because Ren is a good friend. But yeah, I was just wondering if that kind of like going back to that, I remembered and it resonated with me.
Yeah, that paper, Ren did a ton of work on that paper. He was instrumental in that. I mean, that was a combined technical and economic paper. I came more from the economic side, so obviously Ren and Steve, have a lot more depth of experience in the software side of things here, and so that was a really interesting project to work on. And for those kind of following the Bitcoin space, kind of the recent discussions around forks, kind of resurfaced that paper to some extent, because it was literally about exploring the game theory of kind of contested soft forks and the risk models and what can happen. And one of the kind of takeaways is that there's different groups that have different powers and different incentives within the broader Bitcoin ecosystem. So they can be just investors, people that hold the coins. They can be application developers. They can be, the core developers, like the maintainers. They can be influencers that have, a large platform to spread either correct or incorrect facts. And there's other groups, node runners. And we kind of explored that over the course of a soft fork going from an idea to potentially a reality, those groups have different amounts of power, and then it shifts over time. So some groups might have more power early on, and some groups have it later. And as you point out, one of the implications, especially when it comes to a hard fork, where you actually do have two priced forks of the network, it's not just size that matters in terms of selling pressure to favor one chain over the other. It's also the speed, because it is kind of harder to make a comeback once that vicious cycle starts kind of taking effect. There's not a huge sample size of that in Bitcoin or broader crypto history, but there has been some obviously cases. And so I think that paper is still very instructive, and I would remind people that is a living document. So even though that was published something like 2 years ago, it was 2024, it's on GitHub, and it's designed from the beginning to be updatable. So depending on what happens with some of these recent fork discussions, I mean, that's a prime candidate to update it over time as new information becomes available. But yeah, on the custody issue, I do think that there's one of the long-term risks of Bitcoin is if the UX is not good enough to make it broadly held. Now, any sort of like venture scale investment, and Bitcoin's different because it's a digital commodity, it's money, it's not a security. But any sort of like venture thing starts out generally tightly held. There's the founders, there's the early investors, and over time, over many years, as that thing grows and becomes successful, earlier entities kind of cash partially out, new entities come in, and you diffuse that. And when you have like a 150-year-old company like Coca-Cola or Procter & Gamble, you end up with a shareholder base that's very diffused. So far, the longer-term track record or history of Bitcoin is kind of going in that direction, which can take a very long time. But if there was persistently poor UX or education around making it ability to be self-custodied, at least by the percentage of those that want to, that's a friction, that's a problem. And more broadly, and I wrote this for Bitcoin Magazine earlier this summer, they had a print issue, and they were asking about what Bitcoin looks like in 2036. When I think about risks to Bitcoin, it's less about quantum, it's less about risk XYZ. It's more about the risk of disinterest. Basically, that there's insufficient interest or demand in portable, non-debasable, permissionless money. And that's kind of the long-term stagnation risk. And the better that the UX can be, the more it at least helps reduce that risk. I mean, obviously something's easier to use, you can more readily increase the interest, but it's only one factor. And that's also why I work with Ego at Capital to invest in Bitcoin startups that, we invest in companies that try to make Bitcoin easier to use, either for payments or savings or otherwise.
Yeah, I think on that note, it's sort of interesting. I think that this is perhaps one. I want to ask you about your thoughts on this bear market in general, like to the extent that you think there's any differences. But I guess this is a good segue. But one thing that we've noticed in the past 2 years, especially, but I think the past like 6 years, let's call it, with crypto, first was there was this desire to do all of these, ways to move, DeFi and move capital on chain permissionlessly, so on and so forth. And crypto sort of pioneered some of that stuff. When it comes to Bitcoin, we do have there are attempts for the rails, right? We have Lightning, and Lightning is improving. People are working on it. There's some L2s, other L2s we'll see. There's like Arc, and there's a number of things going on. One of the things we've seen as of late, though, is with the introduction of, for example, the ETFs, this idea of, borrowing against your Bitcoin on some permissionless rail or like semi-permissionless rail. It's much easier for the vast majority of people to just borrow against IBIT in their margin account, right? And we're seeing that a lot of these ideas that we thought were as a result of being, permissionless, decentralized, globally accessible, it's actually that it was the only way to do it. And when there are institutional, more trusted ways to do it, people are going that way, right? And we see how much is in IBIT. We see how much is, even like the gambling aspect is now like in treasury companies as of late. I do wonder if you where do you think the UX is with? And I'm sorry, I didn't mean to like just make DeFi the center of it, right? Like there's more, the easy payments, right? Or just like easy self-custodial wallets. But like, where do you see this kind of going? Because it's not, I mean, on one hand, it's increased adoption, but it's not like wildly encouraging with regards to, decentralization and stuff, when like a lot of loans out now are against IBIT, not some, I don't know, DLC thing or something like that.
Yeah, it's a good question. And this is part of why for years I've been generally bearish on the broader crypto space. So outside of Bitcoin, outside of stablecoins, I am bullish on stablecoins. I've generally viewed the total addressable market of these things, including DeFi, as not as large as the proponents or the bulls have generally argued that it would be. Yeah. And that's a large part of it. I think that a lot of the early momentum, part of it is speculation, part of it is VC support. And then another big chunk of it is there's like regulatory arbitrage. So first, kind of the only way to do something, or at least in certain jurisdictions, it's the only way to do something. And around the margins, that I think will still be the case for a while. I mean, if someone is in a jurisdiction where they don't own IBIT or can't own IBIT, and they have Bitcoin and then or another asset, and they want to have liquidity on it without selling it, I think that those avenues will continue to exist. But I do think that they are somewhat size constrained, because once someone finds themselves with a lot of this, and they're in a jurisdiction that they're comfortable with the legal structures around that, they're generally going to gravitate toward more professional solutions. And obviously you take on custodial risk with these things, but then if you do it in the DeFi sense, you trade for technical risk, hack risk. So if you're getting a yield or you're posting collateral, you're hoping that in over years of doing this, that whatever bridge or whatever system you're using is not going to be exploited in some way with money that is for the most part irreversible. And so it's not a free lunch to just say, I'm not going to use a custodian, I'm going to do something semi-decentralized. And so, I do think that the TAM of that is limited. But I do think it's important to have some options. I mean, we've invested in some DLC adjacent things, or at least companies that have a DLC product or development line. I think it is really important. I do think that some peer-to-peer exchanges, ways to trade Bitcoin for fiat, are critical, because if a country just finds itself where Bitcoin is either illegal, or just more commonly just banks just won't send to an exchange. So there has to be avenues for people in kind of modest amounts to be able to get their hands on it. And there are solutions out there, but I think they have to be more. And that is one of the risks. That is the underinvested area, and it kind of stagnates. And I think a lot of it starts with demand. It's kind of a chicken and egg problem, which is If something is hard, people will demand it less. But if people demand it less, then capital providers or developers are less likely to build those solutions because they perceive the lack of demand there. So it's kind of like you have to build it and advertise it, but you have to kind of recognize that as you do that, there's a size issue there, meaning that it could take longer for that demand to materialize than you think, which means you want to be really scrappy. You want to have a long runway with your project rather than expecting this kind of utopian world where half the world's interested in self-sovereign money tomorrow.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. Ellipsis Labs brought capital-efficient order books to Solana and started the Prop AMM revolution with SolFi. Altogether, they've saved retail traders tens of millions of dollars by reducing slippage on spot markets. They're bringing the same level of expertise to perpetuals with Phoenix, which is live today. Ellipsis Labs is backed by Paradigm, Electric Capital, and Han Ventures. I would consider them the foremost experts in crypto market microstructure. The best part is that Ellipsis Labs is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer looking to work with a DeFi team that's already proven itself in the market, go to ellipsislabs.xyz/careers. Okay, so I want to probe a little bit on the stablecoin aspect because you've been quite consistent on this for a long time, like with regards to your bullishness on stablecoins. And I think it makes a lot of sense. In a very reductive way, stablecoins are a way for anyone around the world to get a bank account in US dollars. One thing that I thought more about as of late, though, is that if we extend this same thought process, which is that the vast majority of DeFi is functionally Reg Arb, and that those regulations are ultimately arbitraged away. It's just made legal in some capacity. I mean, like, such a prime example, obviously, is prediction markets, right? Like, had to come up through this Reg Arb, and then Kalshi is like very much regulated now. They're still on the battlefront, but like we've seen this with almost every industry, right? Or every industry that is sort of been, like on the margin legally, Uber, whatever, Airbnb, whatever it may be. With stablecoins, though, what I'm curious about though is, why won't this just ultimately be arbitraged away? Like, why won't Argentina just let you have a US bank account? It has nothing to do with blockchain rails. It could just be like, I don't know, eCash, right? Something like this. When you say stablecoins, I'm curious the extent to which the underlying infrastructure is a blockchain. There are benefits now, which is that like it kind of puts the onus of KYC not on the receiver, right? So like this is, I mean, you can just instantly receive US dollars anywhere around the world. That's valuable, but I see the same pattern. I think, okay, so like, why in the future will we be using stablecoins on blockchains? Like, stablecoins can just be, a dollar eCash instrument or in a database, right? Like, I'm curious, like, where you think this plays out 5-10 years from now, if we're kind of thinking about it along the same lines as all the other arbitrages, like all the other, laws have just been made legal in some capacity.
Yeah, I think about it in a similar way, and that's why, despite being bullish on stablecoins, I've not necessarily been bullish on the rails that stablecoins run on. Some of the, the bulls of the handful of blockchains that have a decent amount of stablecoin volume will say, I'm bullish on this because of stablecoins. I actually have a piece on this. Let me see what it's called. I can look it up real quick. It's one of my more recent articles.
Put it in the show notes too.
Yeah, so it's why most cryptocurrencies won't accrue value.
I've read this. Yeah,
from December 2025. It's kind of like a quick update note to just kind of reiterate some of my bearish views. And they kind of point out other kind of TradFi examples where the rails themselves don't really accrue a ton of value compared to the thing that runs on them, like ETFs or exchanges, for example.
Yeah.
And how some of these were already expensive compared to those things, despite having way less economic activity on top of them. So the short answer is I agree with you that the ledger that things like stablecoins can run on, that's very flexible. That can be shifted over time. It's not something I'm looking to invest in. Instead, I look at it as more of a disruption risk and an opportunity set, which is, we can kind of think of two options here. One is, from a purely technological lens, the international correspondent banking system is clunky, slow, opaque. And having stablecoins, it just materially reduces like the cost overhead of having an offshore bank account, which for Americans, they're like, why do we need stablecoins? It's, well, you probably don't need stablecoins unless you're making a lot of international payments, and you can rely on a business to help you with that. But for the tons of people around the world that want dollar exposure, it basically gives them the ability to do that. And I think people underestimate the next part, which is kind of the choice of jurisdiction. So if you leave out the most extreme cases, North Korea, Iran, or something, you have people in say Argentina, in Nigeria, in country XYZ. They don't necessarily trust their local currency. They still have a lot of options globally, and they can say, well, okay, there's this company in this other jurisdiction that I like better, and they've got dollars that are tokenized, or gold that is tokenized, gold-backed stablecoin, or let's say you're in a country where it's not necessarily easy to buy the best large cap stocks you want to buy, or an index, and you can tokenize that, right? So it's kind of a way of using technology to bring that to more people. Sometimes even if their own local jurisdiction doesn't love that fact, right? So that's kind of permissionless aspect, which is that on one hand, it is easy for a country like Argentina to say, hey, we're going to make it very easy for our population to use stablecoins, and this is going to make our global remittance way easier. But the vast majority of emerging markets, when they run into currency issues, they end up turning to capital controls in some capacity, artificial exchange rates, just ways to slow down kind of attacks on their currency, or people wanting to get out of the currency. And that's where that permissionless aspect comes into play, which again is different than the other direction, which is that, let's say you're in North Korea or Iran or something. The other jurisdictions might sanction you, right? So something like stablecoin might not protect you because you're really sanctioned by the host of the custodied assets. But if you're in a country like Argentina or Nigeria, where that's a much lower risk, the jurisdiction is fine with you having it. It's more your own jurisdiction you might have to worry about. That's where that technology is very, very useful. So I think on one hand, small amounts of global remittance are still expensive to send, more expensive than they should be. Tech can compress that. And then around the margins, it also makes it so you don't have to trust your local banks, your local government. Trusting a local bank with like fractional reserve bank holdings when they don't have a direct connection to the Fed is just it's you're trusting like fractional reserve built on fractional reserve. That's why dollar shortages pop up all the time in emerging markets. And I'm filming this from Egypt. I mean, when they've gotten to a point where they're going to shift their dollar peg. It can be hard to get your hands on dollars in the country safely, and so just different technological options to give people more ability, I think makes a lot of sense. And that I think is confined to a fairly limited number of assets. I mean, dollars, gold, maybe certain equities, kind of large, liquid, attractive assets. I think there's a tokenization aspect, but I'm not investing in the rails personally.
Okay, I want to shift gears a little bit now. Strategy, I think yesterday it was announced they sold another chunk of Bitcoin. It looks like Saylor and Strategy are trying to, show the market they can service their liabilities, whatever those may be. At this point, there's like quite a few. But what do you make of the Strategy situation?
More bullish than I was a month ago. And I actually went on their earnings call. What was it, like 5 days ago? It was July 30th when they had their earnings call. I went on as one of the analysts, and I asked a couple questions around this, mainly related to kind of the counter cyclicality of their Bitcoin buying and selling, and if they might do that going forward. So if people do want to check out the earnings call, the Q&A section, they can see the spot where I asked that, and other people ask questions. So there's a path dependence thing here, which is in the February call, which I was on, I asked about their guidance around their dollar reserves. And I also asked around leverage that was building on top of STRC. Then for the next call, I wasn't on it because I've generally had an every other call cadence with them. But I did ask on X when they were gathering questions. I was like, hey, you said 2 to 3 years of dollar reserves. You dipped to 18 months. Do you have updated guidance around that? And at one point they got down to like 6 months of dollar reserves. And then they obviously there's leverage built on top of STRC. So you have a combination of volatility event and limited reserves outside of Bitcoin. And so now it looks optically, and of course they announced some things a number of weeks ago, which is line in the sand by the board to have at least 12 months of dollar reserves, and a number of other things, buyback programs for their securities. And there's a path dependence aspect here, because I think that the healthiest thing would have just not been to dip down to 6 months in the first place. some of these latest moves are negative for Bitcoin per share, but in some ways they're correcting for the fact that they let themselves get like this in the first place. And so I do think that getting back to their prior guidance is the right thing to do, short of just not having gotten out of that guidance in the first place. So they've already gotten back to their 2 to 3 year dollar reserves. It's interesting because they didn't just hit the minimum. I mean, they're up to 2.3 years, I think. So something like 28 months or something like that of dollar reserves. There's an argument that they might be going too far in terms of defense, but I think that the minimum was getting back up to their kind of 24-month prior guidance. And I think that's healthy. And I think the buyback programs make sense. I've actually even talked about that possibility on X before they announced it. And so I think that's pretty healthy. I think that when people ask, why should this company have an MNAV multiple above 1? I mean, there's a case that it shouldn't, but if you're arguing that it should, generally speaking, the argument you're going to make is that they have better capital access than most other ways of being leveraged long Bitcoin. You know, they can issue prefers and have all this kind of perpetual leverage on it. And two, they can use those to make fairly counter-cyclical decisions, which they haven't done in the past. But according to the answer to my question on the call, they plan to do that more so in the future. And investors can monitor that to see if they are doing that in the future. So I think the fact that they're back up to their prior guidance on reserves, it makes them. The fact that the MNAV premium pretty much evaporated. I do think that STRC is kind of persistently off its lows here. I think that it is kind of on the road to at least partial recovery. And so unless someone thinks Bitcoin's going to have another major leg lower here, which is still possible, I'm increasingly more constructive on strategy than I had been over the past year or so.
Yeah, I think it's interesting. Obviously, I wanted to focus on strategy because it is the largest treasury company. And then, like you said, there's been a lot of consolidation. There's been a lot of shakeout. And then lastly, this point, what you said with like they can better use capital, there is very clear kind of economies of scale when it comes to these things. And I think that this bear market has been like the best evidence of that. Also, by the way, this was more or less predicted prior to the start of all these treasury companies that there's like the market likely can't support 20 strategies. So it's like is nothing really revelatory. I am curious though, and this is kind of like a hindsight is 2020 question, but it's more just regards to the structure of DATs in general, which is, and it's something, this is one thing that I didn't think about. Granted, I was not as in the weeds as you were, and I have paid attention off and on to strategy and treasury companies, but I am curious with regards to like when MicroStrategy started and sort of their, when they got into a Bitcoin strategy, right? Like their stated goal versus what has sort of transpired since. There's one side of it, which is that, they have just continued to kind of like extend leverage or however you want to define leverage here, but they've kind of extended themselves to offer all these preferreds and, bonds and so on and so forth. And people have questioned, like, was any of that necessary? Could they have just stuck with the first mandate, right? Which was like issue equity and buy Bitcoin and like, carry on. The counterpoint to that, which this is the point that I hadn't really thought of, there's no real point of like stasis for these companies in the sense that you're either buying or you're selling, but you have to be in kind of perpetual motion. And I wonder if you've thought about, is there any type of structural flaw, or is this just structural, but not necessarily a flaw to treasury companies whereby they always have to be doing something, either acquiring or selling a little bit in order to appease, their liabilities in bear markets. Obviously, one, like to your point, one of the like kind of arguments with this counter cyclicality thing is that that's almost kind of the opposite of what they've done. And also people don't necessarily trust Saylor to not just decide to wake up and, hammer the market. So I'm curious though, like the long run prognosis of these, one thing that is a valid point is like, there's a Ponzi aspect that may be sustainable, but then there's also the necessity to constantly be balancing and, doing something in the markets. And I wonder, like, have you thought more just broadly about how these things are structured? And then also like maybe going forward, like the prognosis.
Yeah, good questions. So I generally think that so for the major markets, I think that, a liquidity is a network effect, right? So there's a certain size where you can do things that you can't do when you're at a smaller scale. And size begets more size because if you're a large institutional trader, you want to trade the one that you can actually get in and out of with high liquidity. And so, it's self-reinforcing. Now, something like the U.S. market might be big enough to, support more than one. But generally speaking, if you're not the top, few in your market, and that number shrinks as you get to kind of small, like medium-sized markets, you're not really adding value at that point. And so I think the long tail of these smaller ones is just not sustainable. And I do think the strategy's kind of narrative on this has shifted. Partially, I think, because of market conditions. I mean, they started out, they said, okay, we're a software company that's not growing. The market doesn't like it when we hold cash. The market doesn't like it when we buy back shares. So I think they made an interesting decision, especially before all the money, as the money printing started to hit in 2020, they made a decision to put their treasury into Bitcoin. And then even I think the first couple rounds of leverage were defensible because they said, hey, if we can issue inexpensive debt and be long Bitcoin, and we're doing it, we're offering this is before Bitcoin ETF. So there's basically, it's like, hey, we talked about regulatory arbitrage. And basically they were saying there's a gap here. We're going to exploit the gap by institutions that want, Bitcoin price exposure with some leverage kicker. Now they've obviously positioned where the software company is a tiny percentage of their business. It's primarily a Bitcoin treasury company. And in the first few years, they've done these like Bitcoin for corporation events where they've kind of tried to educate other corporations on putting Bitcoin on their balance sheet. And obviously there's been very few takers outside of entities specifically seeking to be quote unquote Bitcoin treasury companies. So let's see a lot of like just widget makers that said, you know what, we're going to put Bitcoin on the balance sheet. I mean, Tesla, SpaceX did it. Block did it, but I mean, they do have Bitcoin products. There's a handful of others that did it, but mostly it's been a kind of a pure play environment. I do think that the pure play is limited, just because there's only so much you can do with that. You saturate demand eventually. It's there for those who like that perpetual leverage attached to Bitcoin, and some kind of just access to capital markets is interesting. So I think in the U.S. and a couple of the major markets, there's still runway ahead for the existing kind of incumbents if they're reasonably well managed. But yeah, I think the long tail, I think that fad is kind of over. I think there's going to be more consolidation ahead as kind of ones that are bleeding out, management salaries eventually get kind of taken out, consolidated, kind of a arbitrage there. I think the bigger idea longer term is just the idea of companies that actually have a business that put Bitcoin on the balance sheet and that are not necessarily trying to be the biggest Bitcoin treasury company out there, and they're not trying to have interest expense that has to be serviced or dividends that have to be serviced by Bitcoin price appreciation. And I think that's a bigger idea longer term. I think it's that the market's not really there yet. I mean, some of the things I'm working on are trying to make that market happen. But I think the era of pure play Bitcoin treasury companies has hit its peak, not necessarily in terms of market cap size, because obviously if you have a really big Bitcoin run, some of these existing ones can do quite well. But I think the fad of just, when in doubt, come to the market with a Bitcoin treasury company or an altcoin treasury company, I think that much like, like ICOs had their cycle, DeFi had its cycle, NFTs had its cycle, even meme coins had its cycle. I think treasury companies had their cycle, and now the remaining portions of that are going to have to be smarter and actually offer something that is not otherwise being offered.
Yeah, and we can segue once I get into your new sort of private equity endeavor, like in this direction. But the last thing I wanted to ask, though, with you said, companies that have perhaps viable cash flows, like they actually create widgets and then turn around and put that into Bitcoin. The thing about strategy is that's not what they do. But with that said, probably the bull case, and it's sort of predicated on some other, parts of the future playing out. But the bull case, which I think is at least it's it's aspirational, but it's the idea that at some point, if Bitcoin monetizes, however you want to define that, but if Bitcoin becomes money, strategy isn't the biggest Bitcoin holder. They're just the biggest holder of money. And there's a lot of things you can do with a lot of money. There's just massive economies of scale. And this is the bull case I hear from people who try to take sort of a pragmatic, unbiased side. The thing about this, though, is this, again, is sort of predicated, like, at least in many ways, on Bitcoin becoming money. And I'm not using the correct terminology here, but there's kind of like some duration mismatch where, like, right now, you have to do all these things to stay afloat, to kind of tread water until we get to that juncture. And that could be 10, 20, 30 years out. I'm wondering, though, like, I look at this and I'm like, okay, sailors escaped from, virtually all, anything that could scare him in the past or scare them in the past, and they come out above water. But there does seem to be sort of an unknown there, which is like how long until we just have the most money in the world, right? And that's the point where I think, I don't know, because they don't have other cash flowing businesses. So like, do you think this is just something they're going to have to manage actively, like a hedge fund, which they've kind of put forth as of late, in perpetuity until there's some like, inflection point or escape velocity where we don't see 50% drawdowns like at the same velocity?
I think there's a kind of a threshold that you can get to before it's money, which is just that it gets larger. You can be gold sized and add a zero to Bitcoin's market cap and still not be, unit of account. There's been like a 40 plus year history now, ever since kind of interest rates started declining in kind of the early 80s, of the way to win in finance is kind of like to play blackjack, which is you buy things that are somewhat scarce, either companies or Manhattan real estate or whatever. You leverage it. If you have better access to leverage than a mom and pop shop somewhere in Ohio, right? So you get a good source of leverage, you get good assets, and you lever it in such a way that you manage not to be one of the ones that blows up when you have a volatility event, a recession, and you repeat that over and over again. If you do it right, you're Berkshire Hathaway. If you do it wrong, you're the meme of the down cycle. Because you failed the path dependence test, you blew up. If you're big enough and you're not first to fall, you can sometimes even get bailed out. It's kind of the story of the global financial crisis. And so that has been kind of like the way to do it, which is you do that and you don't go over like in blackjack. And I think strategy kind of has a similar approach, which is their first round was these kind of like 5-year convertible bonds, which is basically saying that if Bitcoin has some degree of bullish trajectory in line with what it previously had of higher highs and higher lows each cycle, then their leverage was fairly safe and conservative. Obviously, if Bitcoin were to totally change, that'd become a problem. And then they shifted to preferreds, which gives them overall higher interest expense, but even kind of further removes the time or like reduces the time element. So if Bitcoin stagnates, they bleed out over time rather than get kind of a margin call liquidation kill shot, right? So they've kind of structured it, I think, as about as robust as they can, and then it comes down to will they make counter-cyclical decisions or not. There's this issue, and you mentioned before about kind of like companies have to exist in a perpetual environment. And like we see this, like let's say banks, for example, the best banks can hire the best talent. They can incorporate stablecoins or digital payments or whatever. They can have the best practices. If you're a community bank in the middle of nowhere, you're not going to be able to get the best talent. And Strategy actually cited this, which is that when their company was kind of like stagnant, it's like just a fairly small cap software business analytics company. Saylor kind of pointed out that he's survived a lot of this kind of fractured industry. A lot of his competitors failed. And talent was going to keep kind of gravitating elsewhere. They're going to go work at Microsoft before they go work at his company. If your stock's going nowhere for a long time, if you're not a big company, it's just not really seen as the desirable place to go. Whereas when you're a multi-tens of billions of dollars, the leading Bitcoin treasury company in the world, at least people that are interested in that space, that's now like an interesting way to attract talent and things like that. And that's true for many industries. So there's an argument for companies to try to be bigger and more dynamic, just to stop the vicious cycle of bleeding out talent and just kind of diffusing into a nothing. But I think going forward, Bitcoin is just one of the things that companies have as a lever of what they can do with excess capital. You can, if you have excess capital, you can give it back as dividends. You can buy back your own shares. You can fix your balance sheet if you have a lot of existing debt. But a lot of these things, especially the dividends and the share buybacks, are decapitalizing, meaning that when some sort of shock comes or an opportunity comes, it's nice to have like an existing reserve of some sort to do things with. I mean, a recent example was these hyperscalers, these big internet companies. They were building up tens of billions of dollars in cash for a long time with very low or no debt in some cases. And investors are like, what are you going to do with it? Well, now we see what they're doing with it. They're investing heavily in data centers and semiconductors, and we'll see how that pays off. But the point is that they finally, the regime changed, and they said, hey, this gigantic war chest is different now. Now we're going to spend our cash, lever up, and actually invest. And if strategy plays their cards right, which they might or might not, but if they play their cards right, years in the future, Bitcoin's larger and they're a larger company and they got a big reserve of money or money-like assets, and they find an opportunity for an acquisition or some sort of company transformation, they would have the firepower to do that.
Yeah. Okay. Well, then that's a good segue into companies that we hope actually do make real widgets. You are now working on a, my understanding of it is like sort of a private equity holding company that intends to buy small businesses and in some form or another capitalize them with Bitcoin. Well, actually, go ahead. Tell me, the name of it is Orange Juice. What is the idea behind this? This is a recent announcement as well. So, yeah.
Yeah, we announced it. It's orangejuice.com. We got the domain. It's pretty cool. So orangejuice.com. So it is a permanent capital structure, which is a fancy way of saying it's a company rather than a fund. And it kind of touches on the demographics of business owners and the kind of incentive issues of private equity. So there's a lot of, we talked about that blackjack a second ago. It's kind of 40+ year trend of just levering things up. And private equity has really been a key example of that, which they say, okay, there's all these mom and pop businesses out there, and there's some failed large caps out there. There's mid-sized companies out there. And if you're in New York and you have access to good capital, you can say, well, we're going to go up and roll up a bunch of companies out there. We're going to gut their employees, streamline them, lever them up, and relaunch them with a hopefully higher multiple, and just flip them for investors. And and if you've had a 40-year period of declining interest rates, that's felt pretty good. It's been that arbitrage. Now there's a couple of things happening. One is that interest rates are not really structurally going down anymore. So a lot of these private equity funds have just trapped assets. There's also a demographics issue, which is that a lot of business owners are baby boomers, and they don't necessarily have an heir that wants to run the business, and they're looking for liquidity, and they might not want their company gutted. Private equity, when companies are done with a company and they spin it out with leverage, they statistically have higher than average failure rates. It's kind of they've been gutted and left to it's either operate perfectly with the leverage you have or risk going under. And there are alternative models out there. They've not been the incentivized ones. An example actually is Berkshire Hathaway, which is that they will go and buy a business and then just hold it for decades, and then that business is now part of the kind of the fortress balance sheet of Berkshire, and is able to run more or less as they had before. And if they have an opportunity to grow, they can go to Berkshire and say, hey, we think we can use this capital. If they run into a problem, then they're supported by Berkshire. And so we're kind of doing that approach with kind of capital and interest from the Bitcoin space, which is for years now, we've not really seen a lot of companies with cash flow just decide to put Bitcoin on their balance sheet. And if anything, that's the most sustainable way to do it, because it doesn't matter if Bitcoin's in a 5-year bear market. If any sort of interest expense you have is serviced by your operational cash flows, then it comes down to whether or not your businesses continue to be functioning well, and then you can support your Bitcoin assets indefinitely. So what we did is we raised capital. We made the announcement, and we're currently looking to acquire private businesses, and instead of flip them out in 3 to 7 years, gut the employees, lever them up, and spin them out. We actually want to do like the Berkshire model, obviously at a much smaller scale to start with here, just actually holding them indefinitely with no exit in sight, just to build a collection of cash flowing businesses. And then one of our levers, we can use cash to buy more businesses, or we can use cash to store into a Bitcoin treasury. And so just like we talked about before, I mean, these internet companies build up a lot of good reserves, which they were one day able to deploy in an interesting way. Instead of decapitalizing ourselves, or just only buying businesses, and if we're not having reserves, if tough time comes up, we think that the combination of having a set of cash flowing businesses with the Bitcoin treasury is a value add that the market should have, but hasn't yet. And we also think that the demographic trend of business owners kind of deserve an alternative to private equity, which is that ways to sell your business in a way that doesn't gut it. It doesn't, kind of detract from what initially made that business successful in the first place.
What size and verticals are kind of, just as an example, like are of interest to you?
So we're starting out into the $1 to $10 million free cash flow annual free cash flow range for businesses. We are looking at some that go a little bit above that, but that's kind of our target range. That range might change over time as our size changes. For verticals, we're fairly flexible to start with. The kind of the characteristics are American businesses with robust economic moats that are resilient to AI, but that kind of the key characteristic is they probably won't have a lot of growth. We're looking to buy cash flows at fairly low multiples that don't have a lot of growth. And the thing about low growth companies is, if you buy things that are not really growing that much, but you buy them at 5 times earnings, which is not uncommon in the private, company space, you can compound that into very strong returns. Especially, we tend to be somewhat counter-cyclical in our Bitcoin accumulation strategy. When you have the option to either buy businesses or buy Bitcoin with your cash flows or your capital excess, if Bitcoin had just gone up by 5x, that might not be the time to lean into Bitcoin. On the other hand, the incoming funnel of business opportunities to buy will likely be stronger or weaker at certain times. And then so you have these different levers that you can pull, along with the lever of how much you want to be levered, if at all, to lean into these things. So for verticals, we've been looking at anything from like aluminum companies to asphalt companies to business services like printing companies that or business supply companies, dentist things. There's a whole host of businesses out there, and we're very flexible in the vertical. We're more interested specifically in the size, and then more specifically in that it's just resilient, that it's something that we envision that regardless of what happens with AI and things like that 10, 15 years in the future, this is still going to be a recognizable business.
Yeah. On that note, let's transition a little bit into the earlier stage stuff. We talked about a little bit earlier about, your kind of bearishness on crypto stuff. And then, just maybe being somewhat bullish on stable coins, but again, the rails being difficult to invest in, with regards to ego death, the work you do in kind of the earlier stages, what is interesting right now, right? It is, we see all the crypto funds transitioning to be more generalist. And they're massaging it, I think, in many ways by saying, well, fintech and crypto are, the same. And maybe that's true at this point, but it's also a bit of a direction change. But regardless, what is of interest in the early stage right now? It's hard, right? You think Claude can one shot everything? What are you kind of interested in with regards to where you would deploy in an early stage?
Yeah, good question. One is that it's easier with Claude, it's easier to build software than maintain software indefinitely. And in some cases, you also need regulatory kind of clearance, something like a money transmitter license or other licenses is kind of a reality of doing business. So there are still defensible areas around. We think pretty much anything that you can think of in the broad Bitcoin space, at Bitcoin and stablecoins, is of interest to us. So we're very kind of open to deal flow. It's more about how we would structure things. And so, for example, I tend to be, and as a fund, we tend to be, I would say, realistic on Bitcoin as payments, which is that we don't think that we're, round the corner from just people ubiquitously using Bitcoin to buy sandwiches, regards to the layer. And so it's not to say that we don't invest in that. We were early investors in Breeze, for example, which is doing great work on lighting infrastructure. But it's more about how you structure those deals. So, for example, in any sort of payment type of business, we have to go into it with eyes wide open, saying that, okay, this has to be a long, scrappy runway. This has to, the expectation has to be that we're building stuff that is going to take a while to mature. And so the valuation and the runway has to kind of account for that. Whereas there are other businesses where, if anything, we're go faster. You have to reach scale, win this market yesterday. So when you're investing in a wallet, when you're investing in a brokerage, when you're investing in things like that, it's you have to go and win your market quickly, and the market's already there, right? You're taking either from existing incumbents, you're taking from a growing opportunity set of just people that want to buy the asset, and you want to go fast now. You don't want to focus on profitability too early. You don't want to focus on, preserving your runway too conservatively. You have to put the gas on. So I think there's a lot of areas of interest, and you have to manage those differently depending on if you're in a spot that's demand now versus building something for tomorrow. I think one of the challenging things that is, I think, important to us is privacy. So some of the more cypherpunk aspects of Bitcoin, and other than VPNs, it's been kind of hard to sell the public on like why they should care about privacy. But privacy of money, and of course then you have the kind of the propaganda that privacy means illegality, that if only people would want privacy or doing something, that they're up to something bad. It's historically been a more niche industry, again, outside of kind of VPNs. But I think, at least speak for myself, I kind of approach that like payments, which is that if you invest in a privacy solution, there is a market for it, but you want to have wide eyes open that not everyone's going to see it the same way you do necessarily. Like if you're like, I'm really into self-sovereign money and I want things to be private and I want this, and you're kind of technical, you can't really expect that everyone else is going to see it your way a year from now. And so it's a long road ahead, and it's sometimes you need kind of like in kind of the world, you need kind of problems to pop up before people realize they need a solution to that problem. And sometimes they have to run into that problem multiple times. So I think privacy is still an underserved area. And like we talked about before, any sort of decentralized way to acquire or trade Bitcoin is very interesting, or ways of making just trade settlement easier. I think there's a lot of opportunities out there. And just it really comes down to certain types of companies you want to really you want to gun it and grow big quickly. And other ones, you have to be very conservative with where the market is and make sure you're not too far ahead of it.
Okay, last bit now. Let's talk a bit about, I don't know, maybe where we are in the market. I think one question this was a request from one of my friends, Rajiv. He said, and I think it's a good question, where does the next bid come from with Bitcoin? And I'll add a slight bit of context, which is that obviously the last bull run, we had the president of the United States shilling Bitcoin alongside his little scams, but we did have him shilling Bitcoin. And we also had mention of a Bitcoin strategic reserve. It looked like that was the inflection point. And I think a lot of people, myself included to some extent, thought we had maybe not reached complete escape velocity, but it was a new paradigm. And that nation states were coming, and that it was up only from here with, very, dampened drawbacks, if you will. We've now gone back right to our 4-year cycle. It's actually followed fairly closely. It seems like just if you look at the price of Bitcoin relative to its all-time high, it's so big, it takes a lot of money, right? It takes $1 trillion plus to move back just to our all-time high. And I think a lot of long-time holders have either gotten shaken out or are questioning, where's the next bid, right? What are your thoughts on this? Just, you can run with that question.
Yeah, good question. I think, so in the last cycle, I think one of the more disappointing aspects was that the retail bid was weak. And it really was the corporate bid. Now, I actually think that the corporate bid is not done yet. Kind of like how, Strategy, that was their second cycle. So it wasn't like it was a totally new bid. So that was the ETF and the Treasury company bid. Like I said before, I think the Treasury company fad has peaked, but I do think some of the existing incumbents will be sizable buyers in the next cycle, most likely. Same with ETFs. I think probably an underappreciated element is the high net worth element, including some of them being somewhat self-sovereign in a sense, which is, anyone paying attention to New York right now, for example, people with their fairly large investment properties got kind of doxxed, basically, and are facing potentially selective taxation on them. And I think around we've seen capital migration out of California, and Europe has their own different things going on, and so I do think that the high net worth kind of portable capital area is bigger than people think. People also point out, not every millionaire in the world can have one Bitcoin, just numbers wise. So that is a gigantic bid that has not really shown up. And I think that the more either capital controls or real estate specialty taxes and things like that, as they ramp up, as the whole West is pretty much in fiscal dominance. We see it both on the right and the left. Like I mentioned New York, but we have, the president talks about sometimes basically price controls, taking stakes in companies, telling companies what they can or can't do. Obviously, tariff policy. So this can come from multiple directions. As a country enters fiscal dominance, you get more of these things popping up. You don't just have this kind of hands-off, private sector can do what they want approach as frequently. And so I think the appreciation of just portable liquid capital is compelling. And narratives feed on price sometimes. So sometimes just something stops going down on bad news. And then, traders say, hey, that chart doesn't look like dumpster fire anymore. Maybe I might allocate to it. And then momentum traders come in and say, hey, this thing's actually going up. Maybe I'll buy it because it's going up. And then when it goes up, it has another news cycle. And then you have more property taxes kick in. And then you have people say, maybe having a non-zero amount of this asset is not a bad idea. And if someone's worth 10 million or 100 million, non-zero could mean, $1 million of allocation. And there's tons and tons of people like that out there, or smaller, other kind of entities. So I think that's still a untapped market, either for this cycle or the next cycle.
Are you mainly bullish, or do you think we have likely bottomed here?
I think likely, but I think I'm more confident to say I think that we're in a kind of a bottoming zone, rather than trying to call it a bottom tick, which is that I think sentiment's washed out. I think a lot of leverage is washed out, and fast money is elsewhere. I mean, it's into the AI trade, and even that's kind of facing issues now, but that's elsewhere. And I think that the pendulum will shift back. I'd be surprised to see us go below like a 50 handle, right? Yeah. So I think the downside is more limited and the upside is multiples in the years ahead. But I do think it'll still take a little bit of time to dig back out of this and build kind of positive momentum.
Yeah, I think the last thing I wanted to ask, and it's more just you can kind of go wherever you want with this question, but you mentioned before that the biggest kind of risk is this idea of disinterest. And I think a lot about that as well. And I also think about how, gold, regular gold did very well. And I think that this past cycle, and I think that a lot of us thought that there was going to be some turning point, not necessarily like supplanting the market cap of gold, but that Bitcoin would start to really make headwinds on the market cap of gold and prove itself as sort of that apex store of value. And that didn't really happen. And I say, look, I mean, Bitcoin's been around for 20 years. We give it a bit of time, right? Gold has been the dominant store of value to the extent that there's been a store of value, it's been gold, right? Like a global, non-sovereign store of value, it has been gold for eternity. So we can give Bitcoin a bit of time. That said, though, I think there have been some people who I thought believed very strongly in the value proposition who have been shaken out, maybe not entirely shaken out, but have just questioned, wait, we have gold. Is this just another asset? And when something's just another asset, these things, I think, tend to be winner take all, with stores of value. And in fact, I don't even really think there's a ton of stores of value. I think that was something that was regurgitated a lot within crypto. And then even elsewhere, you see this, people think fine art is a store of value. And it is kind of, but it's a collectible really, right? And there's a much finite market for a Rothko or Picasso than an ounce of gold. And so there are massive kind of economies of scale with single apex assets. So all of this diatribe aside, where do you think Bitcoin looks, 5, 10, 20 years? What is that kind of, and you mentioned some, right? Capital controls, easy liquidity, so on and so forth. But it does seem to me that there needs to be kind of a dominant narrative, and it has to be somewhat sustaining. And I do think that people, like I said, have been shaking out this cycle. And I wonder if you've thought about that at all. And have you changed any of your, I mean, I think the answer is no, but have you changed any of your thinking around, is this going to be the one, right? Is this the asset?
Yeah, the short answer is no, but it's also because I've been a dual bull on gold and Bitcoin since I got into Bitcoin. I mean, I was bullish on gold before I got into Bitcoin and remained so. And so I do see that people that kind of view as all in might be questioning that, and that might be a reasonable thing to question. I mean, when you have 100% of your net worth in something that swings this much, I mean, people do get burnt out eventually. Whereas if you kind of diversify to a handful of things, it reduces that. I think that, I mean, part of going back to my structural bear view on the broader crypto space is that I do think liquidity network effects matter, security network effects matter, and if you're not first, you're kind of last in that sense. And so I don't think there's a room for like a ton of different digital assets that just all become stores of value. I think it really consolidates toward one. And when you compare gold and Bitcoin, I mean, part of why I like both is because they don't perfectly fill each other's gaps. I mean, gold has got this multi-thousand-year track record. It's obviously resilient to the types of things we've seen over the past week. But the key one is that it does debase at a fairly slow rate. I mean, it debases an average of like 1.5% a year.
It's not perfectly scarce.
Yeah, supply growth. And two, it's got portability constraints, which if someone's like living in the US and they don't really see themselves ever like having to bring physical gold with them somewhere, maybe that's fine, right? So if you're in the hunkered down store of value approach, I mean, gold does solve a lot of problems. And that's why I'm bullish on it. And that's why it's, it's a 20 trillion plus asset for a reason. Whereas, there's 200 countries in the world. A lot of people do move borders. A lot of people do have problems with their own jurisdiction. And people often do want to be able to move that value and audit that value quickly. Whenever a country tries to repatriate its gold, it's a multi-year process at the sovereign level to transport and audit it. It's kind of funny. And even just kind of institutional or large, high net worth. I mean, it's challenging to move that around between jurisdictions. And Bitcoin can do it, with a handful of confirmations within the hour. Or someone can fly around with 12 words written down, hopefully generated with proper entropy. But they can do it. They can even set up just multi-jurisdictional multi-sig and things like that. And that portability element is really interesting. I mean, and there's a spectrum of portability. I mean, gold is more portable than real estate, which is relevant. And Bitcoin is more portable than gold. And then Bitcoin has some, it's got that absolute scarcity aspect. But then, of course, it does have some questions that gold doesn't have, quantum or security budget stuff, or just the overall kind of ability to, technical risk, either of protecting your own coins or the network as a whole. It's a 17-year-old asset. So as I would phrase it as long as it keeps being the leader in what it does, which is, decentralized, portable, store of value, liquid money, that's I think the total addressable market of that is big. The question is how big, right? I mean, obviously the better UX is, the more robust it ends up being in the face of technological growth over the next 5, 10, 15, 20 years, the bigger that TAM is. Whereas the more frictions and problems that people run into, the smaller that TAM is. And I think the good news is that even if you reach half the TAM of gold, that's still a massive, that's a zero compared to the current price. And then the bulls would say, well, it's gold but faster. So why can't the TAM be bigger if a number of hard challenges get answered and defended against? So I do think that there's plenty of upside if you think it continues to be the best at what it does, and that what it does is worth something more than 0.1 or 0.2% of global assets, which I would put myself in that camp.
Awesome. I agree. Lyn, this has been fantastic. Thank you so much. Thanks for taking the time. Also, she was able to get the domain, orangejuice.com, so check that out. I really appreciate it. Thank you.
Thanks for having me.